In modern economics, we are taught that money is a commodity. It can be bought, sold, rented, and leased. But in the architecture of ethical finance, treating money as a product is the precise point where economic stability collapses. Today, we break down Riba. To understand why interest is banned, you have to understand what money actually is. Sharia finance dictates that money has no intrinsic value. It is simply a tool to measure the value of real goods and services. When you charge money to lend money, you create an artificial economy built entirely on an illusion. Scholars and financial bodies classify riba into two precise dimensions. Riba al-Nasiyah, which governs modern banking and debt, and Riba al-Fadl, which governs unfair exchange and trade surplus. Let's break down both. Riba al-Nasiyah is the interest we see all around us today. It is the predetermined premium a lender charges a borrower simply for the element of time. It is the foundation of conventional credit cards, mortgages, and sovereign bonds. Conventional systems argue that interest is simply the time value of money. But Sharia principles reject this if it's guaranteed without risk. Why? Because time belongs to no individual. To charge a fixed penalty or fee purely for the passage of time shifts 100% of the real-world risk onto the borrower. When we screen stocks for our ethical portfolio, this is the exact metric we target. If a company leverages interest-bearing debt to fund its operational growth, and that debt cross-contaminates their balance sheet past 30% of their market value, the asset is disqualified. It is fundamentally fueled by Riba al-Nasiyah. While Nasiyah deals with loans, Riba al-Fadl deals directly with trade. It was established by the Prophet Muhammad, peace be upon him, to prevent disguised interest and exploitation within market bartering systems. The foundational rules highlight 6 standard commodities: gold, silver, wheat, barley, dates, and salt. The rule is uncompromising. If you are exchanging the exact same commodity, the transaction must be immediate and the quantities must be identical. 1 kilogram of high-grade dates for 1.2 kilograms of lower-grade dates on the spot is prohibited as Riba al-Fadl. How does this apply to a modern digital investor? Look at currency trading or foreign exchange. If you are swapping money for money across currencies, the delivery must happen on the spot. Deferring delivery to profit off future fluctuations is a direct modern derivation of Riba al-Fadl. Ethical finance doesn't restrict capital growth. It forces capital to earn its profit legally. Instead of guaranteed interest lines, capital must enter partnerships where profit is explicitly generated through real business performance, trade margin, or leasing assets. Even when investing in non-financial companies like Apple or Nvidia, they often generate tiny amounts of interest income on their massive cash piles. To keep your wealth completely clean, we deploy a process called dividend purification, which we will map out in an upcoming video. The money-for-money ban isn't an archaic rule, it's a sophisticated economic stabilizer designed to prevent capital from detaching itself from real human labor and tangible industry. In our next lesson, we move to the second frontier of risk, Gharar and Maisir, defining exactly where healthy commercial risk ends and prohibited gambling begins. Hit subscribe and let's build wealth with a conscience.